when you are done, right? You just click on this app and you click to go to the computer. And then you pay from your PC and you go to the computer.
Thank you. Good afternoon, ladies and gentlemen. I'm Menno Glas. I will be your tutor today for BAL 200 for the CGT tutor question. That everyone prepare the question. Okay, typical students. So let's read the required first. Calculate Gerard Marlborough's taxable income for the 2020 year of assessment. Round off to the nearest rand, that's not that important. Provide brief reasons where you are of the opinion that specific item has no effect on the calculations. Ignore the effect of that in this question. Okay, so you have to calculate the taxable income and give reasons for null effects. Let's start at the top. Gerard is the sole proprietor and owner of one of Pretoria's most prestigious bakeries. SARS regards baking as a process of manufacture. So out of the first sentence, what triggers do you see for capital gains tax? Just looking at the first sentence, Gerard is a sole proprietor, Yes. Yeah, you have capital allowances that you have to recoup when you sell an asset. Anything else specific to sole proprietors? What inclusion rate do we use? 40%. Do we have an annual exclusion of 300,000 in the year of death? That's correct. A process of manufacturing that relates to your section 12C manufacturing assets and property used in the process of manufacturing. Section 13. Okay. In his free time he enjoys going on canoe trips in Europe. Gerard has always been a resident of South Africa and is married out of community of property to Alicia. Married out of community of property to Alicia. That's very important when we get to the last note as well. Gerard disposed of the following assets during the 22 year of assessment. What triggers CGT in the first note? Excuse me? No, like when does CGT comes into play? Okay, and what's your disposal in the first note? Sold it. Correct. Gerard sold one of his canoes, Canoe 8, about 13 meters long, to his son, a connected person, for 70,000. The canoe had a market value of 18,500 on 30 April. This canoe was purchased exactly 5 years ago at the cost of 15,000 rand. Okay, if you sell an asset to a connected person, which amount do you take into account? The amount of the fair value or the selling price? Why the market value? In this case, the selling price is way lower than the market value. It's to adjust that you can't like benefit the purchaser because it's a connected person. You can't grant him an asset for less than the value of that asset. Okay, let's just read this additional information, then we can start with the calculation. Gerard's Bakery had a sales of 414,000 during the 2022 year of assessment. The bakery's purchases and other expenses, all tax deductible for the period, amounts to 400,000. It excludes rental on the assets disposed of. Gerard had an assessed capital loss of 5,500 brought forward from the 2021 year of assessment. Okay. Can everyone see there? Okay, this is the same format you will follow in a exam question or in a test. It just makes it a lot easier to answer and keep track of all your calculations. I'm just going to write TI for taxable income. Okay, you do agree that the sales we include in gross income for the year. So it's 414,000. Then we had expenses, all tax deductible, for 400,000. Okay, for note 1, let's start. I'm just going to first we have the recoupment. What is the formula for a recoupment? Yes, sir.
The price, the executive price.
Yes, you are correct. So what's the selling price for Canoe A? It is 17,000, correct? No, it's your market value, it's 18,500. But it's limited to the base cost of 15,000, so you have your recoupment. Let's see. Proceeds of limited to your base cost is 15,000. Then we have the tax value, that's your base cost, and the Canoe doesn't have any allowances on it. Base cost would be 15,000. So your tax value is 15,000. Just check that. So you have no recoupment as your proceeds are limited to base cost equals your tax value. But what is the capital gains on Canoe A, if any? Capital gains is your proceeds reduced with your recoupment less your tax value. So using that formula, what's your capital gain on Canoe A, if you have any capital gain? Yes. Excuse me? 3.5 and not, it's not disregarded. Yes. So if it's less than 10 meters, it's a personal asset, and in a personal asset you can disregard any gain or loss. So you're correct, the CGT is 3,500 each year. Your market value, 18 and a half, reduced with 15. Then you include this in this CGT column, because you're going to make yourself confused if you include it in your taxable income, and it would be incorrect at the end of your calculation. You will see why if we get to note 6. That's 3.5. Okay, note 2. Note 2, primary residence. There's 2 exclusions you can get in a primary when you dispose of your primary residence. It's the first 200 or 2 million in proceeds, or the first 2 million in your gains. So which one would you use here, the gain rule or the proceeds rule? Why?
Because the gain on your proceeds, 7.3 million minus 2.5 million is greater than 2 million.
Yes, you're correct. Do you have any allowances on a primary residence? So you go straight to your CGT calc, you don't do a recoupment. So your CGT, I'm just switching colors, that does not right lekker. CGT would then be 7.3 minus 2.5. Then you get what's your gain on that? It is 4.8 million. After you calculated this preliminary gain, then you only can deduct that 2 million primary residence exclusion. You can't deduct it before using, you can't say 7.3 minus 2.5 minus 2. You first have to show them the gain is greater than 2 million. Then you utilize the exclusion. I'm just gonna that will give you 2.8 million gain. And you transfer that to your CGT column. Any questions regarding note 2 with the primary residence? Okay, moving on to note 3. Note 3. Canoe B. Gerard purchased Canoe B, 8 meters long on 2 March 2013 at a cost of 22,000 rand. The canoe is sold for 27,000 rand to a third party on 17 August 2021. Any recoupments on Canoe B? Okay, if you don't have a recoupment, any CGT on Canoe B? Why?
It's a personal use asset.
Why?
The boat's less than 10 meters long.
Yeah. You should stay in the question, you should just state boats less than 10 meters. You can say the boat's 8 meters long, in brackets just say it's less than 10 meters, otherwise they wouldn't give you the marks. So just state no CGT, personal use asset, boat is less than 10 meters long, it's 8 meters. I'm just going to write here no CGP. Okay, note 4. Gerard sold one of his bakery buildings on 21 December 2021 at the cost at the purchase or selling price of 600,000. The bakery was completed and brought into use at the cost of 560,000. Okay, which allowance do we get on building used in the manufacturing process? And at what percentage? You can't answer anymore. Okay, so section 13, allowance of 5% per year. Do we apportion the 5%? That's correct. So we first have to do a recoupment. Okay, our proceeds. What's our proceeds taking into account for our recoupment? Matt? Ja, limited to? 560, isn't it? To the base cost. So your proceeds limited to your base cost would be 560. Then we have the tax value, which is our base cost, less our allowances. And our, what's the current? The current is 2022 allowance. Our base cost is 560,000. For the first 9 years before the beginning of this current year, how much of the allowances, what's the amount of the allowances that we already have claimed? It's 5% times 9 times 560, what's that?
It's 152,000.
252,000. And for the current year? Yes. This is the 20. Our calculate garage Marlborough's taxable income for 2022 year of assessment. Okay, that doesn't change. Okay, but what's the 22 then? It would be the same as the 2023 allowance. What's this allowance then? It's 5% of 560. 20? 28,000. Okay, 23. You agree it's the same, it's still 5%. Can we deduct the 28,000 for the taxable income purposes for this year? Why? It's related to? It's in the production of income. Yes, you're correct. So you can transfer this to the taxable income column. Alright. Then your tax value is your 560 minus 252 minus 28 minus 28. That would give you what's that? Of the 2022 year of assessments answers. Job happy I can. So your tax value is that correct? Alright. So what should you then include as your recoupment? $308,000. Can you see that if you sell an asset above the base cost, the proceeds is more than the base cost, your recoupment will be equal to all your allowances claimed. So it's a fast way to check if you are correct, but that only relates to when your proceeds are more than the base cost. Okay, now to the CGT. Our proceeds is 600,000. Less our recoupment that are included in taxable income. Less our tax value. think that's like 40,000, is it? Yeah. Then you have a capital gain of 40,000. Do you agree? So you transfer the 40,000 to the CGT column. Okay. Or are you still writing down? Can I take it off? Okay, now for note 5, the bakery oven. Okay, our equipment will be what's our proceeds? How much did we sell the oven? Perfect. 94,000. Our tax value. Base cost 94,000. Now my allowances are for we purchased it in the 2021 year, so it's the first year we used the bakery oven. At which percentage do we write it off on the 12C? Why? Why 40 and not 20? New and unused. So, do you agree that the first 2 years you will write off 60% of your base cost? Amounts to 56,400 allowance already claimed. Then in the current year of assessment, do we apportion the 20% for the months used? So tax value would be 18,800. Do you agree with me? So what would the recoupment then be? Yes, that's correct. 75,200. CGT. Okay. Our proceeds for this, for the CGT calculations. What's our proceeds? You said 1,660,000. You're correct. What did you say, sir? Oh, you did the whole CGT for that. Yeah, the proceeds is 116,000. What do we subtract now from our proceeds? Our recoupment, correct. 75,200. After we subtracted the recoupment, we need to deduct the tax value, not the base cost. Or you can subtract the base cost at the date of disposal. That's the same as the tax value. Tax value is 18,800. What's our capital gain on this? You're correct, 22,000. Okay, note 6. Holiday. Gerard donated his holiday home to his wife on 30 June 2021. The holiday home was purchased in Paris in 2011 at the equivalent of 1.1 million. They used this holiday home during the summer vacations in Europe. They still continue this home for the same purpose. The market value of this holiday home was 5.5 million. Now, what word triggers CGT in note 6? Because you need to have a disposal before you can do any CGT calculations. So what word triggers is a donation. It's correct. Why is a donation considered as a disposal? It's the transfership of ownership, or the transfer of ownership. So now his wife got full control over the asset. Okay, any recoupments on a holiday home? Why not? Why can't we have a recoupment on a holiday home? It's not? No. Can't get the recoupment because you didn't claim any allowances on a holiday home. That's why. You're thinking of the capital gain exclusion. So you can't have a recoupment on this holiday home because it's not in the production of income, and you can't claim an allowance respectfully on that holiday home. Okay, now the CGT. What would the CGT consequences be of the holiday home donated to his wife? Why no CGT? Yeah. So any transfer between spouses does not trigger any CGT. Correct. Okay. What is the total capital gain or capital loss Gerard made throughout the whole year? also, yes.
2,865,500.
Correct. Any capital losses made? No. Okay, a question to you. When do we deduct the annual exclusion? Before we take into account an assessed capital loss of afterwards? You take it into account before you include your assessed capital loss brought forward from the previous year. What's our annual exclusion for this year? 40,000. So you deduct your 40,000. What do you get then? It's 282.5. After you calculate that your aggregate capital gain for the year, then only can you utilize the capital loss you recognized in the prior year brought forward to the 2023 year of assessment. So that would be your 5,500 capital loss. That is the total capital gain Gerard had for the 2023 year of assessment. Now you use this figure and your inclusion rate to determine the capital gains tax payable for him for the 2023 year of assessment. At which rate do we include for a sole proprietor? 40%. That's correct. So please in a test just show your calculation of 40%. They won't award you a mark for that if you don't show that you know it's 40%. Do you all get the 1,128,000? After you've calculated your inclusion of 40%, then only can you transfer it into your taxable income column. And since they only required us to calculate the taxable income, you can just add all the amounts together. And that would give you your taxable income. Do you all agree with the amount that I've got for taxable income? Because I know for the 2022 year of assessment, the one I did it correctly. Okay, just lastly on capital gains tax. Capital gains tax consists of 4 parts. You have an asset, you have a disposal of an asset, your proceeds and your base cost. If you have all those 4 in a scenario, you can proceed with your capital gains tax. If there's no disposal, you won't have any capital gains tax on the asset in that scenario. Any other questions? Nothing. Okay, now then you are free to go. I will be here if you have any questions.